Okay, let's dive right into this explainer by exploring a financial concept so powerful it will literally change how you think about money forever. Whether you're completely new to investing or, you've been stashing some cash away for a while now, understanding the raw mechanics of this single mathematical principle is absolutely the bedrock of financial literacy. Today, we're going to completely demystify what a lot of experts consider the ultimate wealth secret. To kick things off, I want you to picture a fascinating little thought experiment. We're going to compare two different investors who contribute the exact same monthly amount. Just imagine these two people. Person one gets a head start right at age 20. They put in a modest amount every single month, but after just 10 years, at age 30, they stop completely. They never add another dime of their own money. Now, person two waits until age 30 to start, but then they invest that exact same monthly amount continuously for the next 30 years without missing a single beat. So, looking at those two paths, who do you think ends up with more money at age 60? Most of us naturally assume the second person wins, right? Hands down. After all, they invested for 3 times as long and put in way more of their own hard-earned cash. But here's the wild part. In many realistic scenarios, depending on the average return rate, the first person actually ends up wealthier. I know, that sounds like a massive math error, but I promise you it's not. So, how on earth can someone who invested far less of their own money win? Well, let's get into it. Part 1, the mechanics. How compound interest actually works. Okay, let's break down the math. It's actually super straightforward. Look at the difference here between simple and compound interest. Let's say you invest $1,000 at a 10% annual return. In year one, both simple and compound interest earn you $100. Makes sense, right? But check out year two. With simple interest, you only ever earn 10% on your original $1,000. But with compound interest, you earn 10% on your original money plus the $100 you already earned in year one. So in year two, compound interest pays you $110 instead of $100. Now, that extra $10 might seem totally insignificant right now, but it is the exact spark that ignites extraordinary wealth. Because as the years go by, your money begins creating more money, and then that new money creates even more money. It accelerates dramatically. It's literally like a giant snowball rolling downhill. That snowball doesn't get massive because someone is running alongside it manually packing on handfuls of snow. It grows because the snow that's already attached naturally scoops up even more snow as it rolls. Your early interest earnings become the base that captures all your future interest earnings. This brilliantly illustrates why the early years feel so painfully slow for beginners. When you start, your gains might just be a few dollars. It definitely doesn't look life-changing. But compounding is exactly like planting a tree. For years, the growth seems completely invisible beneath the surface. Phase 1 is incredibly slow, Phase 2 becomes a little more noticeable, and Phase 3 becomes absolutely extraordinary. And this is exactly why patience is the single most valuable financial skill you can ever develop. If you get bored and quit during that invisible phase, you never get to the extraordinary phase. So to really make this work for us, especially without a massive income, we need to understand part 2, the ultimate leverage, why time is everything. All right, let's jump back to our very first example. Person 1, the investor who stopped completely at age 30, had only one single advantage over person 2. Just one. They didn't pick secret better stocks. They didn't have some massive tech salary. They just had 10 additional years of compounding cycles. Because they started at 20 instead of 30, that initial money had a whole extra decade to multiply, earn returns, and then earn returns on those returns. It's basically a recipe, and compounding really only needs 3 ingredients. First up, you've got your principal, which is just your starting money. Second is your return rate, which is the percentage of growth. And third is time. Now, while your starting money and return rate are definitely important, time is the absolute magic multiplier here. It allows growth to stack upon growth repeatedly. That means a modest, steady return over 40 years will almost always beat a high, risky return over a really short period. Think about it. You can always earn more money later in life, but you can never, ever create more past years. Now that we know the recipe, let's explore part 3, real-world application, where to find it. You might be wondering where this actually happens in everyday life. Well, compounding isn't just some classroom theory. It's built into almost every solid financial vehicle out there. It happens in basic savings accounts and fixed deposits, where banks pay you interest on your interest. It happens in mutual funds and ETFs, which is where you pool your money to buy a basket of stocks. And it's incredibly powerful through something called dividend reinvestment. That's when a company pays you a share of its cash profits, and you automatically use that cash to buy more shares. Basically, anytime your gains remain invested to generate future growth, you are actively using this force. This brings us to a total mindset shift. Most of us are taught to view money purely as a tool for consumption, something you earn just so you can go out and spend it. But once you truly grasp compounding, you realize every invested dollar is actually a tiny worker. That worker goes out and generates earnings. Those earnings, they become new workers. Instead of asking how much you can spend today, you start asking how much future growth your financial workforce is out there creating for you right now. Before we get to the action plan, let's clear a few things up in Part 4, Debunking the Myths, What Most People Get Wrong. There are a lot of mental barriers that keep beginners from starting. First, compounding does not make you rich overnight. It is deliberately slow and relies on decades, not days. Second, it's definitely not just for the wealthy. The math literally doesn't care how rich you are. Consistency matters way more than the size of your initial deposit. Third, higher returns don't always win. Chasing wild, high-percentage returns usually introduces massive risk that can completely wipe out your foundation. And finally, starting later is not fine just because you plan to invest bigger chunks later. Like we just saw, lost time is incredibly hard to replace. Now, we do need to talk about the catch, because this math is totally neutral, which leads us to Part 5, the dark side, when compounding works against you. See, this step-by-step breakdown shows exactly how debt compounding works, especially with things like credit cards. Step 1, you carry a balance. Step 2, the bank adds high interest to that debt. Step 3, the very next month, you are now paying future interest on the previous interest you were just charged. It's wild. The exact same force that builds immense wealth can rapidly magnify your financial problems if you carry high-interest debt. It's essentially that same snowball, but this time it's rolling right over you. Okay, so how do we make sure we stay on the winning side of this equation? Let's move to Part 6, the action plan, how to maximize your money. If you want to harness this power, you really just need to follow these rules. Start as early as humanly possible, even if it's just a tiny amount. Stay consistent to build up that momentum. Always, always choose to reinvest your earnings and dividends rather than cashing them out. Try to avoid frequent trading because that interrupts your long-term growth and triggers annoying fees. And speaking of fees, control your costs by choosing low-fee investments, because every single dollar taken in fees is a dollar stolen directly from your future compounding engine. Following these simple rules protects you from the absolute biggest enemy of compounding, impatience. Now look, if you still find yourself doubting that small, boring, consistent actions can actually lead to huge wealth, just remember this curve. Human brains are naturally wired to think in straight lines. If a plant grows an inch one week, we expect it to grow an inch the next week. We expect linear growth. But compounding is exponential. It curves upwards dramatically, and that is exactly why our intuition struggles to predict it. It feels completely unintuitive right up until the moment it suddenly feels like absolute magic. As we wrap up this explainer, let's tie it all together with Part 7, the true secret of wealth building. Throughout the financial world, compound interest has earned a pretty legendary title, the eighth wonder of the world. And it absolutely deserves it, because it transforms ordinary, consistent, and honestly kind of boring actions into truly extraordinary financial outcomes. You don't need a genius IQ for this, and you definitely don't need to perfectly time the stock market. You just need to set it up, step back, and let the mathematics do the heavy lifting for you. So I'll leave you with this one question to think about. Are you giving your money enough time to turn into wealth? Remember, the greatest advantage you have isn't a massive salary or picking the perfect breakout stock. It's time. Your tiny financial workers are waiting for instructions. What are you going to put them to work on today?